Hi, welcome to the Macro Show. We talk macro, and you wonder, did the Fed really increase its QE purchases? We've got that. We've got unemployment claims, producer price index, Treasury auctions, dealer holdings, capacity utilization, some other charts showing that perhaps the supply chain problem is really the cause of inflation. And man, we've got a whole bunch of great stuff because we've also got the consumer credit data. It's not going the right way anymore. I'm your host, Steven Van Metre, and welcome to the show. And back to our headline topic is, did the Fed really increase its purchases? Now it did. It went from $80 billion a month of U.S. Treasuries to 80.5. Now I know you're saying, well, wait a minute, only $500 million? Look, it's statistically not relevant. It doesn't really matter. But if you put this in context, what have we heard recently, right? We have 3 foreign central banks tapering their QE purchases programs. And what does that cause? It's cause pundits to go around saying that at the Jackson Hole, Wyoming FOMC meeting, the Fed's going to have the talk about the taper talk. I know, we have to have talks of talks. It is coming. And by January of next year, boy, the Fed is going to be massively tapering, perhaps raising rates. And yet, they just increased their purchases. Now, we knew there was going to be a change to the QE program coming. We knew that. We talked about it. Let's go look at the details, because is it long bond friendly? Oh, yes, it is. Let's go take a look. And this is this chart courtesy of Barton Options on Twitter. And he broke down the different duration. And of course, where did he get this data? Right from the New York Fed website. So anyways, you can go to the New York Fed website under Markets and Policy Implementation, under Treasury Securities. You can find your way to the QE schedule. You can find out what day the time is consistent and what they're buying and how much. And he put it together for us so we could make it really easy to understand. Now, the 0 to 0.25% duration, they trim slightly. This I'm surprised about, because when we look at the dealer holdings, this is where there's a fair amount of inventory in the 2 years. So I actually expected this to go up. They trimmed it a little bit. They also trimmed their 2.25 to 4.5 year purchases by, again, a little bit. Not much, $1 billion here, $1 billion there, not a whole lot. And they left the 4.5 to 7 year alone. But here's where a lot of the changes started to happen. Let's go through tips first. They decreased the 1 to 7.5 year tips. Now, I thought this would go down considerably, but they left that alone. They left the 7.5 to 30 year loan, and they just slightly decreased the 1 to 7.5 year, which is surprising because there's not that much demand at auctions for tips in general. They're over purchasing here, so I thought that they would funnel this down into the curve. Now, you might say, oh no, but they dropped the 30 year purchases, the 20 to 30, which is all 30, from 10.5 to 8.1. Now, keep in mind, I track the auction data every month. The dealers, on average, take $5 to $5.5 billion per auction. So the fact that the Fed was buying 10.5 was great. The fact that they're only going to be buying 8.1 still means they're buying more than the dealers are taking. Now, there were some problems, and we've looked at this auction data, and we've noticed the 20-year, which seems like the Treasury is very excited about, hasn't been met with very strong demand, and consistently kind of mediocre demand. Well, now what's happening here is there's going to be a 10 to 22.5 year purchase, which is going to pick up, some of the 30 years that it decreased, right? But anyways, we'll assume that it's mostly here to buy 20-year Treasury securities. They're picking up $5.7 billion. And this is not entirely all the dealers are getting, but it's actually, you know what? I think their dealers are getting a little over 5 here, or getting around 5.7, sometimes a little more. So this is actually going to help eat up that 20-year supply and perhaps improve the 20-year auction. And then they're also going to increase the purchases of 7 to 10s, and that's going to 6.45. So you've got this total going on of 7.25. That number is going up quite a bit. So they're increasing what you might want to call almost like kind of the belly of the curve. Now, on one hand, you say, well, that's not good because they decreased the 30-year. Look, here's what really matters. They're increasing the overall duration of their purchases. And since we've looked at this in the past where long rates are correlated to short-term rates, there's like an 80-some% correlation. So if a lower end rates are staying low or falling, the long rates are going to go with it. So the fact that the Fed, even though they're not buying as many 30-year, are still pulling back, are buying more 20s and 10s, that's great news, because that just means it's going to put downward pressure on interest rates. Remember, the market thinks that QE causes rates to go up, but we know for a fact it does the exact opposite. So this is really good news. Again, the $500 million extra, it doesn't really matter. Barton didn't add this up. I did. I was like, wait a minute, it's $500 million over. And then I added this up, and I'm like, wow, it's $500 million over. So I think that's going to eliminate the talk about the taper talk coming, since the Fed actually did a stealth increase in its purchases. Let's take a look at the economic data. And let's go right into Thursday here into the U.S. and we have unemployment claims. So let's go right to the Department of Labor website. And unemployment claims last week went up. They were revised higher to 507, so 7,000. So remember, we had that below 500,000 print. Well, that went up. But finally, now we have a print potentially. We'll see if it's revised up or not. Next Thursday, of 473. Now, this is a good trend that we're headed lower, but it's way too high. I mean, the typical unemployment claims when everyone's working is 200,000 to 300,000 a month. So this is still too high. But one of the challenges we see is when we look at total claims and bring in the pandemic claims. You see pandemic claims went up almost 700,000. So the total change in terms of all unemployment benefits went up 700,000. And so you can on net look at that and just say, well, if 473 are initial claims here, what does that mean for pandemic claims? That means there are people that are going off state claims onto the federal programs. This is not good, because I've been using this number kind of as a rough proxy for where the non-farm payroll reports are going, and now we're going in the wrong direction. And if you think about wrong direction, what's going on with stimulus? Well, this month, remember, there's only 15% of this checks left to go out. So there's now not a lot of stimulus to drive this. And what have we been hearing? We know there's 16 states that are looking at stopping their pandemic claims, which is an extra $300 a week. The estimates, assuming this happens, and based on what I know, it would not start happening until next month, is going to cut this number here, this 16.8 million, down by approximately 2 million. So if that happens and this number drops, well, we can't say those people all went back to work just yet. We'll still have to watch the regular claims. But this is not a positive indication of where the economy is going. We should not see people going from state claims onto pandemic claims. We want to see them going off state claims and back to work is what we're looking to see. All right, let's take a look at the producer price index, because this got a lot of excitement. Now remember, producer prices are what's coming out of the factory. So month over month, it went up 0.6%. That's a pretty sizable number. And year over year went from 4.2 to 6.2. And some people are screaming, inflation, there it is. Can't you see it? It's inflation. And even the core is excluding food and energy, in month over month went up a massive 0.7%. That's a big number. And that drove the year over year rate from 3.1 to 4.1. And how can you not believe, right? Hey, there's inflation coming out of the factory. That's got to be passed on to the consumer. Well, let's explain something here. The producer price index is not correlated with the consumer price index. The producer price index is correlated with the CRB commodity index. That's really where if you draw those, and it's not in the Fed database, so I can't do that. But that's where you see the relationship to producer prices. Now let's look at the history of this, because everyone's now going, look, there's this inflation. And what is the belief? What is driving this belief that we're now seeing inflation? Because people believe that quantitative easing is money printing. Now, have you been a fan of the show for any length of time, or maybe listen to my recent Macro Voices interview, or you're going to hear the recent interview with the Wall Street Silver. It's kind of like Wall Street Bets, but it's a Reddit forum for Wall Street Silver. We talk about this all again because they believe this was money printing. We went through this process. Now, if you believe, maybe you do, that is money printing and that is driving the PPI higher, then what about quantitative easing 1, 2, and 3? Weren't they money printing too? Well, if your belief is this is, then that had to be, even though we all know it wasn't. Let's go back and look. When did we have QE1? Well, that started in 2009. And wow, that QE1 certainly drove producer prices down further, and then finally went up. And how long did we have QE on and off for? 1, 2, and 3? Oh, all the way through into 2014. So despite doing QE, we had disinflation, deflation, and then we had this sideways inflation with a little bit of inflation, disinflation, deflation, and that all ended after QE with deflation. But this is inflation now, right? This is called transitory, and you're going to see that the transitory deflation in 2015 was transitory. The transitory inflation in 2018 was transitory. Remember, here we have deflation. Why didn't this go further? Because, I mean, that's the idea, right? If it's going in one direction, it's just screaming deflation. Was transitory, will be transitory as well. I know a lot of people don't believe that, but that's what's going to happen. I mean, again, a QE is not money printing. So we know that. Let's go on. We got the 30-year bond auction. Now, keep in mind, 2.395. There's something significant about that. Do you know what it is? Well, let's take a look at the auction. This auction was not the super best 30-year auction in history, but it was a good auction. And it went out at the high yield to 2.395. We'll round that up to 2.4. The low yield was down to 0.9. That was like about quite a bit lower than last month, and the bid to cover slightly below the 6-month average. But again, this was a rather large 30-year auction, and overall take was pretty good. And here you can see the dealers taking 5.4. So if we come back to Barton's chart here, what does he say? Oh, the Fed's buying 8.1. Not an issue, right? No issue there at all. So what is significant about this 2.4%? Well, I'm glad you asked, because that's called resistance. And what we see on the 30-year is 2.4. Up here, this lower purple line, resistance. 2.4, resistance. It got through, but overall resistance. Going back to 2019, resistance. Even into mid-2019, resistance. So what do we know about 2.4%? It's resistance. And what is that going to tell us where rates are likely to head when it cannot go higher? It tells us rates are going lower. And I think what we need to have here coming soon is a macro thesis update. I'm getting real excited about what we're seeing in the bond prices and whatnot. So maybe next week we'll do a macro thesis update. I'm kind of excited to do that. So hopefully I'll have some time. Now let's take a look at dealer holding. So this comes out on Thursday, and what do we see in dealers? Right, they have almost 19 billion in T-bills, not a ton. How about in coupon securities? Now here's the 2-year and under. They're sitting on a little over 47 billion. This is why I thought the QE purchase would increase here, but they didn't. But look at the 3-year. There's a negative 1.6 billion. What does it mean? There's a shortage. I know, a shortage? Yeah, a shortage of 2 to 3 year maturity notes. How about in the 3 to 6 years, holding about 6.4? Not a big number. And how about 6 to 7 years? Shortage, minus 1.2 billion. And 7 to 10 went from a shortage now to a slight net positive, but this will get eaten up. And then the greater than 11 years, which again, as you probably know, I wish would be broken out to 20 and 30, is at 39. So we should see some potential downward pressure here as the Fed mops up some of the 20-year that I think there's a fair amount of 20-year sitting in here. Could be totally wrong, but that's just my opinion on that. Moving into South Korea, we see export and import prices double digits in April, 10.6 and 15.0 respectively. Makes sense. There's a lot of base effects from this time last year that we're going to see. How about Spanish CPI year over year up from 1.3 to 2.2? So finally getting some inflation there in Spain. And look at the month over month, 1.2. So that's definitely driving inflation over there. And moving into the U.S. data here on Thursday, retail sales, complete miss. Looking for a 1% increase, came in flat. Now keep in mind, flat isn't actually bad. That just means it hit the same month over month. I mean, so it was same as March to April. Is that going to last? Now I want you to think, is that going to last? Because remember, 85% of stimulus checks went between March and the end of April. So what is coming for retail sales as stimulus goes away? Yeah, it's going to go down. And what's going to happen if those 300 a week unemployment benefits go away? What's going to happen to retail sales? It's going to go down. So this was a miss because, of course, the market was expecting anything higher than zero. Year-over-year changes at 51.22%. Of course, base effects right there. Looking at excluding gas and autos, down minus 0.8%. And the core, excluding food and energy, down minus 0.8%. So definitely seen in the retail sales that we're at the end of what came from the stimulus checks. And how about where is the control group? Retail sales, where are you? Here, control. This feeds into GDP calculation, minus 1.5%. Now, one thing I'm always interested in is the import price index and export price for the U.S. Month over month, exports went from 2.4 to 0.8. So that means they still increased, but they increased at a slower rate. So what is that telling us? That perhaps we've seen a peak and this is slowing down. How about import prices went from 1.4 to 0.7? So again, it's slowing down. Its growth is slowing. Now, if we look at import prices against the CPI, we see, that makes sense. We're seeing that import prices are driving the CPI. And as all of those ships start showing up, with cargo and getting unloaded, we can expect some downward pressure on that. Now, of course, we do know that the CPI wasn't totally driven by the rise in import prices, but you see the relationship between the two. So we like to know that, yes, this relationship is still valid. If import prices on a year-over-year had rolled over or started going down or were flat, then we might put some check into this rise in the CPI, but otherwise those two are lining up. Let's move on. We've got let's see, capacity utilization. This is great. 74.4 last month, 74.9. This is a percentage of the factories in the U.S. that are being utilized. So what percentage of a factory is being utilized? A great look at inflation is in capacity utilization, because in blue, if you want to get inflation, you need capacity utilization up at 80%. And even then, you can see as capacity utilization rises, so does CPI. And why is that? And it's simple, because when there's so much demand for goods and services, the factories start hitting 80%, which is a lot of capacity for them. They start bringing on extra shifts and start running the equipment a little harder. That means there's demand, and that means they can get away with sustainable price increases. What you're seeing here in the capacity utilization is saying, this increase in the CPI is not going to last. It's not going to hold. Not from that perspective. Maybe from some others, but not from that one. Industrial production in the U.S. up 0.7% month over month. Manufacturing production up 0.4%. Let's talk about the University of Michigan preliminary May survey. And what do we have? Consumer sentiment down. Consumer current conditions down. Expectations down. The only thing they got was 5-year inflation expectations were up, as were normal inflation expectations. And guess what? The consumer is a terrible predictor of inflation. They are just reacting to what they see. So you start looking at potential peak CPI, peak prices paid to the ISM, and peak consumer expectations, then you know if there's a peak potentially building in yields. And what do we just look at in Treasury yields? It says, there's looking like a peak here, because it's not likely not to get any worse. And that's why you're starting to see a reversal form here. Not only cannot break 2.4, but it's the bond market's telling you, this is probably not everything that you think it's going to be. All right, let's move on, see what else we've got in the charts. We've got the ACT for hire trucking index. Looking at driver availability, people say, no, this inflation is real. It's here to stay. I keep saying supply chain issues are a big part of the problem, and look at that. Driver availability deteriorating. Can't get people in trucks to move goods and services to the end user. So that's a problem. That leads to higher prices. How about home builder sentiment? Remember, home builders are super bullish, whereas home buyer sentiment is now at the lowest level since the early 80s. So if you build it, will they come? So far, home buyers are saying, nah. All right, let's take a look at the assets and liabilities of all commercial banks. And this is the H.8 report. And now we've got bank credit up $24 billion. So that looks pretty good. But securities and bank credit were up 40. So what does that tell you? There's some negative numbers coming. And you've got mortgage-backed securities up $20 billion. Treasuries are up 14 billion, so they're buying the recent lows. How about loans and leases? All commercial banks down 6 billion, commercial industrial loans down 10 billion, real estate loans down 6 billion. What about the consumer? Are they still going? Nope, flat. And what happened? Credit cards down. So consumers, it looks like they're back paying down credit cards. And what was up? They're still buying cars and some other loans there. Cash at banks was only up 4 billion. Just so you know, I did put an article out today, consumer prices and interest rates. I will link this in the description below. If you're following me on Facebook, Twitter, or LinkedIn, you can also find it there. All right, let's take a look at the PowerPoints here, and then we'll wrap up the show. Real estate loan growth is up to minus 1.08% from a year ago. So remember, we've seen deceleration in real estate loans, and now a contraction in that despite interest rates falling, 30-year mortgage rates falling, then rising, and now they're back down. The only question is, how low will they have to go to turn this number into a positive number? So it tells you rates got to go way down. Commercial industrial loan growth down to minus 16.54% from a year ago. The 3-month rate of change is back falling. The 6-month rate of change is falling, and they're going deeper. That's not a positive sign at all. Bringing total loans and leases, all bank credit, down to 4.85% from a year ago. This looks very recessionary. Normally this is post-recessionary, but we're still in one, especially with over 16 million people in unemployment and a 6 and 3-month rate of change both falling. The only good news here is consumer credit loan growth is up to 3.57% from a year ago thanks to stimulus, but we should expect to see this in the weeks to come to start to flatten out and roll over as, of course, we see a lack of stimulus, lack of extended unemployment benefits, and consumers getting nervous and going back to paying down their debt. Anyways, thanks for being fans. As always, we got the cool little stick things. Like and subscribe. I already know you will, so I appreciate you being fans. We'll see you on Sunday for the chart show, and then we'll be back on Monday for the macro show. I'm Steve Van Metre. Bye now. The content of this video is provided as educational information only, is not intended to provide investor and other advice. This material is not to be construed as a recommendation or solicitation by our selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.